Welcome to the Deep Dive. Today we're looking into something that's, well, really opening up investment opportunities. REITs, real estate investment trusts.
That's right. For a long time, getting a piece of those big commercial properties, the shiny office buildings, shopping centers, that was really just for the big players,
Yeah.
right? Huge capital needed.
But REITs, they're changing that completely. Think about investing in those same assets, but maybe starting with figures we've seen mentioned are around 5,000 rupees, maybe even just 300 for a single unit.
It really brings commercial real estate investing to, well, almost everyone, democratizing it, you could say.
And the timing seems interesting too, especially in India.
Oh, definitely. We're seeing real momentum. Just a few years ago, what was it? One listed REITs.
Just one, yeah.
And now we're at 4. And honestly, all the signs point to more growth. The whole commercial real estate sector here is booming.
So that's what this deep dive is about. We want to get into what REITs actually are. Why are they taking off in India now? How do you, figure out which ones are good investments?
And how they stack up against, say, buying a physical property yourself.
Right. Because REITs seem to offer some real pluses there, like being easier to get into and out of. Liquidity.
Yeah, liquidity is a big one. And, Indian investors often love property. REITs just offer a different, maybe more manageable way into the commercial side.
And to help us unpack all this, we're using insights from places like Zerodha Varsity and Markets by Zerodha. We've got perspectives from experts like Alok Agarwal at Brookfield India Real Estate Trust and Pratik Shah from K. Raheja Corp., who manage Mindspace REITs.
Some really knowledgeable folks in the space. Their insights are super valuable here.
Okay, let's dive in. At the most basic level, what exactly is a REIT?
So think of it as a trust. It pools money from lots of investors, could be individuals like you listening, institutions,
Okay.
and it uses that pool of money to buy and manage commercial properties that actually earn income. So shopping malls, offices, hospitals, that sort of thing.
So pooling money for real estate. Is the mutual fund analogy fair?
It's actually a pretty good analogy, yeah. Like an AMC, an asset management company, collects money to buy stocks or bonds.
Right.
A REIT trust collects money, but specifically for real estate. And you get units in the REIT, just like you get units in a mutual fund, representing your share.
Got it.
Yeah.
That makes sense.
Yeah.
So for me as an investor, what's the payoff? What are the main benefits?
2 main things, really. First, capital appreciation. If the value of the properties the REIT owns goes up, the value of your units should hopefully go up too.
Okay, value growth.
And second, income, regular income. The REIT collects rent from tenants, and then it has to, by law, distribute a big chunk of that income back to the unit holders, usually as dividends.
How regular is that income?
The rules say at least twice a year, but in India right now, most of them are actually paying out quarterly.
So it's kind of like getting rental income, but without owning the building yourself and dealing with tenants.
Exactly. That's the beauty of the pass-through structure. The income and any capital gains sort of flow through the trust directly to you, the investor. No hassle with paperwork, maintenance calls, finding tenants, none of that.
That sounds like a major convenience factor.
It really is. And another key thing, especially for managing risk, Indian regulations say REITs have to invest at least 80% of their money in properties that are already built and generating income.
Ah, so less risk from like funding a construction project that might run into problems.
Precisely. It shifts the focus to stable income-producing assets, gives you a bit more predictability.
Okay, that makes sense. So we're seeing this growth spurt in India. What's driving it? Why now?
Well, there are a few big factors. India's position in global outsourcing is huge. We've got, something like 51% of the global market share?
Wow, that much.
Yeah, and that translates directly into massive demand for office space. We're talking around 80 million square feet leased annually. It's a lot.
And that's just outsourcing.
That's a big driver. But you also have the growth of global capability centers, GCCs, tech companies expanding, plus just the overall Indian economy growing at around, say, 7% GDP. All that needs physical space.
So the REIT growth is really tied into India's broader economic story.
Absolutely. And it's interesting, right now, the market here is mostly office REITs. There's only one retail REIT currently listed. That reflects where the big demand has been.
It definitely feels like there's a lot more room for this market to grow, doesn't it?
Oh, for sure. Look at the U.S. market. Thousands of REITs, market cap in the trillions of dollars. Compare that to India. 4 REITs, maybe $12, $15 billion total market cap.
That's a huge difference.
Huge potential runway for growth here. We're really just scratching the surface.
Okay, so let's compare this directly. Someone knows about buying, say, an office building or a shop directly. How is investing in a REIT unit different?
Big differences. Liquidity is probably the first one. Buying or selling REIT units. It's like trading stocks. You can do it quickly on the exchange.
Right, much faster than selling a physical property, which can take ages.
Exactly. Selling commercial property is a whole process. REITs give you that ease of entry and exit. Then there's professional management,
Meaning?
meaning you're not the landlord. The REIT has professional managers, an investment manager, property managers handling everything, finding tenants, maintenance, collecting rent, all that stuff.
So it's pretty hands-off for the investor.
Largely, yes. And REITs usually own a portfolio of properties, so they get benefits of scale. They can negotiate long leases, often with big multinational companies, and those leases often have rent increases built right in.
Built-in increases, like automatically going up each year.
Yeah, often something like 5% to 8% annual escalation is written into the contracts. That helps income grow predictably and kind of hedge against inflation.
That's a nice feature. What about costs? Buying physical property has lots of costs.
Right. With REITs, transaction costs are way lower. You don't have the brokerage fees, the stamp duty, property taxes directly, or those ongoing maintenance headaches and costs.
And the entry ticket is smaller, as we said.
Much smaller. You can buy just one unit if you want. Makes it accessible to way more people than buying a whole building.
Okay, so easier access, liquidity, professional management, lower costs. That's a strong case versus direct ownership for many people. So if I'm interested, how do I actually analyze a REIT? What should I look for?
Good question. It breaks down into a few key areas. You need to look at the portfolio, the financials, the debt situation, occupancy and leases, and finally, valuation.
All right, let's take those one by one. Portfolio evaluation.
First, what kind of properties does it own? Office, retail, industrial, a mix. Then, where are they? Geographic spread is important for diversification. Is it all in one city or spread out? Like, Mindspace has properties in Mumbai, Pune, Chennai, Hyderabad. That spreads the risk.
So don't put all your eggs in one city's basket. Makes sense.
Exactly. Then, who are the tenants? Quality matters. Are they big, stable companies, especially MNCs? Mindspace, for example, says about 74% of their clients are MNCs. That suggests reliable rent payments.
Okay, reputable tenants. What else?
Tenant concentration. Is the REIT overly reliant on just one or two big tenants? If one leaves, that could be a major hit. Diversification among tenants is good too. And finally, just a general risk of the locations. Are they in business-friendly areas with good prospects?
Got it. Evaluating the actual assets and who's paying the rent. Now, financials. What numbers matter?
You start with revenue, which is mainly the rental income. You want to see that growing steadily over time, ideally. Then look at net property income, NPI. That's the rent minus the direct costs of running the properties, like maintenance. It shows how profitable the actual buildings are.
Okay, revenue minus property expenses, NPI.
Right. And then crucially, the distributable income per unit holder. This is basically the profit that's available to be paid out to you, the investor. Mindspace, for instance, reported about $249 per unit distributable as of March 2023. You want to see this number looking healthy.
So growing rent, profitable properties, and a good chunk of cash available to distribute. What about debt? REITs use borrowing, right?
They do, yes. So assessing debt is critical. Key metrics here are things like the interest coverage ratio. Can the REIT easily cover its interest payments from its earnings? Higher is better. Mindspace was at 4.5 times, which is pretty comfortable.
Okay, ability to pay interest. What else?
The weighted average cost of debt. Basically, how much is their borrowing costing them? Lower is obviously better. Mindspace was around 7.7%. And also, the weighted average maturity of debt. How long until their loans need refinancing? Longer is generally more stable.
So manageable interest payments, reasonable borrowing costs, and debt that isn't all coming due tomorrow. Makes sense.
Look at occupancy.
What about occupancy and the leases themselves?
Very important. Occupancy rate is key. What percentage of the space is actually leased out? Higher means more stable income. You want to look at the trend, too. Is occupancy going up or down?
Stable or rising occupancy. Check.
Then, weighted average lease expiry, or WALE. This tells you, on average, how long the current leases have left to run. Mindspace is around 7 years.
Is longer better or shorter?
It's a trade-off. Shorter WALE means you can potentially increase rents faster if the market is hot, but it also means more turnover risk. Longer WALE gives you more income stability and predictability. Depends on your view. And finally, tenant retention. Are tenants renewing their leases? High retention is a good sign of stability.
Okay, so high occupancy, a WALE you're comfortable with, and tenants sticking around. Last piece, valuation. How do I know if the price is right?
Several ways to look at it. One is the net asset value, or NV, often reported by the REIT itself. It's their estimate of the property's market value per unit. You can compare the current market price to the NAV. Mindspace's NAV estimate was around 371.5100.
So if the market price is below NV, it might be a bargain.
Could be, but it's just one indicator and it's the company's own estimate. Another metric is price-to-book ratio, market price divided by book value per unit.
Look at the history of this ratio for context. Mindspace is about 1.23 times book.
Okay, price to NAV, price to book. What else? Dividend yield. This is crucial. It's the annual distribution per unit divided by the current market price. So what return are you getting as income? Mindspace was around 6.2%. You compare that yield to, say, what you could get from a bank FD or a government bond, considering the risk.
Right, comparing the yield to safer options.
And some people also use technical analysis, looking at the price chart of the REIT units, trying to find good entry points near support levels. But fundamentally, it's about NAV, book value, and especially the dividend yield.
That's a really helpful breakdown of the analysis process. Thanks.
Yeah.
Now, we mentioned office and retail REITs. Are there other types emerging in India?
Yes, the landscape is definitely evolving. You have the standard real estate investment trusts, REITs for property assets. Then there are infrastructure investment trusts, INVESTs, which focus on things like roads, power lines, infrastructure.
Okay, REITs for buildings, INVESTs for infrastructure.
And recently, SEBI introduced rules for small and medium REITs, or SM REITs. These focus on smaller properties, maybe valued between, say, 50 crore and 500 crore.
Interesting. So smaller scale real estate.
Exactly. They offer exposure to a different segment. Might be more concentrated bets, potentially higher growth, but maybe less diversification than the big REITs with huge portfolios.
So possibly a different risk-reward profile with SM REITs?
Could be, yeah. And looking ahead, we'll likely see more specialization, like in global markets. Think data centers, warehouses. Those sectors are growing fast in India. We might see specific REITs for those.
Data center REITs. That makes sense with digitalization.
For sure. Some existing REITs already hold some data center assets, and there's already a warehousing invite, actually. We might also see more composite REITs that hold a mix of different asset types.
So growing diversity in the types of REITs available. Now, how do these REITs get money to grow? If they pay out most of their income, where does expansion capital come from?
Good point. Since regulations force them to distribute, typically 90% of cash flow semi-annually, they often need to raise money externally for growth, like buying new buildings.
How do they do that?
Two main ways: equity and debt. Equity means selling more units through IPOs initially, maybe follow-on offers later, or placements to big investors like QIs or private placements. Similar to regular companies raising equity.
Okay, selling more shares, or units in this case, and debt.
They can issue bonds at the main REIT level, or more commonly, perhaps, the debt is taken on at the level of the special purpose vehicles, the SPVs. These are the actual entities that own the properties.
SPVs. Why the distinction?
Well, currently in India, banks aren't allowed to lend directly to the REIT entity itself, but they can lend to the SPVs that hold the assets. That might change, but for now, that's how a lot of the debt financing works.
Interesting structure. So when they raise this money, equity or debt, and buy properties, how do we know if it's a good move for us investors? What are the risks?
The key word is accretive. Any acquisition needs to be accretive. That means it should actually increase the distribution per unit for existing holders and ideally the NAV too.
So the deal has to make existing investors better off.
Right. The risk is they might overpay for a property or buy something in a weak market or a building that doesn't perform well. That would dilute value instead of adding it.
And are there safeguards against that? Governance rules?
Yes, thankfully. The Indian regulations have strong governance built in. There are limits on how much debt they can take, a maximum 49% loan to value, and they need unit holder approval and credit ratings to go above 25%. That keeps leverage in check.
Okay, debt limits.
Plus, rules about independent valuations for related party deals to avoid conflicts of interest. And unit holders get to vote on major decisions. And remember, these office REITs showed resilience even during the pandemic, collecting most of their rent. That speaks to the quality.
Seems like a pretty solid regulatory foundation. Now, what about interest rates? They've been a big topic globally. How do rising rates affect REITs here?
It's definitely a factor. Higher interest rates mean higher borrowing costs for REITs with floating rate debt, which can squeeze the cash available for distribution. And higher rates can sometimes put pressure on property valuations too.
So potentially lower payouts and lower asset values.
Potentially, yes. But there are counterpoints. Indian REITs tend to run with lower debt levels, often below 40% loan to value, well under the 49% cap. That provides a cushion.
Layer leverage helps absorb the shock.
Exactly. And if you look historically, especially in the US market, REITs have sometimes actually outperformed during rising rate periods.
Really? How does that work?
Because real estate, especially with those built-in rent escalations we talked about, can act as an inflation hedge. If inflation is pushing rates up, it might also be pushing rents up, which helps offset the higher borrowing costs.
Ah, so rising rents can counteract rising interest costs.
Ah.
Interesting dynamic. Okay, let's talk taxes. Crucial for any investment. How does REIT income get taxed in India?
It's actually quite efficient, generally speaking. It's designed for single-level taxation. So the distributions you get,
Yeah.
the part that's classified as a dividend, is usually tax-free in your hands.
Dividend part is tax-free.
Okay. The part that's considered a return of capital is also generally tax efficient. But if part of the distribution is interest income passed through, that part is taxable at your normal income tax slab rate.
So, mostly tax efficient, but watch out for the interest component. What about selling the units, capital gains?
It follows the equity structure. Hold for less than a year, sell at a profit. That's short-term capital gain, taxed at 15%.
Okay.
Hold for more than a year. That's long-term capital gain. It's taxed at 10%, but only on the gain above 1 lakh per financial year.
So, same as equities. That seems pretty favorable compared to, say, taxes on physical property sales or even dividends from some regular companies.
Yes, the tax structure is generally seen as one of the attractive features of REITs in India.
All right. So, for someone listening, maybe thinking, okay, this sounds interesting, I want to start, what's your advice? How should a beginner approach REITs?
First step is education. Really understand the basics we've talked about. Then look at the specific REITs available. Understand their portfolios, what properties, where are they, who are the tenants.
Do the homework on each one.
Absolutely. Do your due diligence. That being said, the current listed REITs in India are generally well regarded, managed by reputable sponsors, so it's a decent starting pool.
And then just jump in.
Maybe start small. Invest an amount you're comfortable with, see how it goes, get familiar. You can always increase your investment later as you get more confident. Remember, it's likely a long-term growth story for the Indian market.
Start small, learn, grow the allocation over time. Sensible approach. Let's touch on the overall regulatory environment again. You said it's strong.
Yeah, it's considered quite robust. SEBI's done a good job aligning it with international standards, particularly Singapore, which has a mature REIT market.
And strong governance rules.
Very much so. Things like the 80% completed asset rule, the mandatory distribution, the rules on related party deals. These are often stricter than for regular listed companies. It's built to protect investors.
And there are industry bodies involved, too.
Yes. The Indian REIT Association, IRA, plays a big role in awareness, governance standards, policy advocacy. And for the new SM REITs, they're setting up a self-regulatory organization, an SRO, to boost transparency and trust there.
More oversight is good. Any other tools for investors?
Actually, yes. SEBI recently pushed for data benchmarking platforms. So now providers like CAMS Online, KFinTech, Harvey have platforms where you can find standardized, comparable data across different REITs. Makes analysis easier.
That's fantastic. Easy access to comparable data. Which cities are the main hubs for these REIT assets right now?
For the office REITs, the big concentrations are in Mumbai, Pune, Delhi NCR, Kolkata, Chennai, Bangalore, and Hyderabad. The retail REIT might have a wider spread, maybe into Tier 2 cities too.
Okay. What about Gift City? Any REIT action there?
It's still being discussed. Listing REITs in Gift City has tax and regulatory implications that need ironing out, so nothing listed there yet. And investing in overseas REITs, or vice versa, is possible, but depends on specific RBI and SEBI regulations at the time.
So, areas to watch. In between REITs and InvAtes, is one generally easier for a retail investor to get their head around?
Maybe REITs are slightly more intuitive for many people, especially office and retail REITs. We all see and use offices and malls. Infrastructure like power lines might feel a bit more abstract, perhaps, but both structures are relatively straightforward once you grasp the basics.
Familiarity helps, I suppose. Okay, this has been really comprehensive. If we were to sum up the key takeaways for listeners.
I'd say REITs offer a practical way to get into commercial real estate. You get potential for regular income, potential for capital growth, plus liquidity and professional management. And the tax structure is pretty attractive, too.
And the outlook in India seems strong.
Definitely. With economic growth, urbanization, the potential is significant. Experts really see REITs becoming a much bigger part of the investment landscape here. the number of investors is still tiny compared to mutual funds, so there's huge room to grow.
It's an interesting thought. Could the REIT market's growth sort of track India's overall growth story in the years ahead? It could become a really core asset class for many.
I think that's a very real possibility.
Well, if this has sparked your interest, definitely check out resources like the Indian REIT Association's website and those new data platforms from KMS, KFinTech, Carvey for more research. We'll be back soon with another deep dive. Thanks for tuning in.